Welcome back to the channel, guys. Today's video, we have two things. One being why it's too late after this particular date. And the second, one thing to watch for tops in the market. You don't want to miss this one. So if you are new here, hit the subscribe button now as each video builds upon the previous day's analysis. And like the guys who have been following for some time, they know the importance of following up with the analysis. Now, if you have enjoyed it, you've found value, hit that like button. Goes a long way to helping out the channel. So let's kick it straight off with the two things I want to look at in today's video. I've just spent the last several hours going through the chart, back testing, looking at what happens after this date, how much time there is after this particular date for upside potential, and how much upside potential there is in the markets. Now, in yesterday's video, I looked at elections and what the market does leading up to an election and then after the election, more on a weekly to 2 to 3 month time frame. This time I'm looking at what happens from now up until a breaking point after the election. Basically a nice clean run of gains, and when that ends, how long had that run been in months and how much percentage gain has there been. The analysis I'm doing is going back 104 years for the S&P 500, and we'll obviously apply that to Bitcoin. So let's kick it off. Some short-term stuff. Usually I start with the traditional finance, but I just want to have a look at Bitcoin right now. It's it hit the 50% level on the short term here. So you got the top, the low, 50% through the middle at 63,200. It has been rejected. However, at least for the last 24 hours, it's been holding up. It's holding up above this low, and above the major low here at $49,000. The interesting point here is that there was increased volume at that high when it got rejected, so going from 64.5 down to 62. And then the next day, which was the day it just closed, had lowering volume, with the closing price around the same level. So I think we've just got this little bit of chop until the market decides whether this is going to break out to the upside and basically take out 65 to 66K, or if it's time to retest lower prices. Now, the first point, I'll go straight into it at this stage of the video. Make sure you hit that like button. Anyway, the inflows towards the peaks of the markets and sometimes the lows as well, but I've noticed it around the peaks. You'll see an influx of analysis surrounding on-chain analysis. My view on on-chain analysis, and maybe it's because I just haven't found a great way to use it, apart from using it as a contrarian indicator, is that on-chain analysis is useless. Basically 100% useless when it comes to forecasting the with the trend direction. What does that mean? Well, when we look at on-chain data, one would expect that if you're seeing inflows, more coming into the market, you'd expect that that it's just getting started. The run is just getting started to the upside. Inflows, price increase. Outflows, price decrease. What we have seen is essentially the opposite. Not every single time. So it's not trying to figure, well, here are the inflows, and it was 9,500 on this date, and 10,100 this date, and 11,400 this date. You're not trying to pick that there's a top every single day. What we're trying to use here is, in conjunction with other signals that we obviously talk about on the channel and go into great detail when it comes to TIA Premium with our members, so on and so forth, is looking at specific turning points. And I'll bring two to your attention that have just happened. So the big warning here is any analysis that focuses on on-chain analysis as a way of determining where the market's going to go, most importantly with that direction, I think is useless. And I talked about this in the previous cycle. In 2021, all of the on-chain analysis was absolute garbage, telling us that the top wasn't in, there was heaps more money coming into the market, or at least a lot more people buying, and that meant the prices should keep going up. But they kept going down, which led me to think there's something wrong here. And the same thing with the lows. You can see the outflows coming in, and that has led to significant lows. Not always the exact low, like you can see here with May 1st, 9,700 outflows out of the ETFs, but it was a significant low at the time for BTC. So that low is here, May 1st. It held up the market for quite some time until it broke down in July. So basically 2 months in a bear market is a pretty good signal to hold the market up. Most outflows at the low, and then the market rallied to 71,000. The idea behind this is that the masses are usually wrong around the peaks. They're not always wrong through the trend, but they're usually wrong around the peaks. And that's basically the theory that I use throughout a lot of my trading. So you could call it a contrarian indicator around those peaks. Nonetheless, let's have a look at a couple of the quick examples here. High outflows, recent example, and you're comparing it to recent time or recent history as well. So October 1st, high outflows, and basically the market stopped dead at about 60K. Sure, it went a few $100 lower, but nonetheless, that was a reasonable turning point and then rallied to 64,000. On October 1st, this date here, you had the highest outflows that Bitcoin had seen since around the 3rd of September and the 5th. So what did the 3rd and the 5th look like? Well, they're around the lows here. You got the 4th because the data comes out for the following day. It's quite kind of like the fear and greed index. Nonetheless, there is the 6th. Lowest was around the 5th and like I said, the 1st. And now you've got a turning point, quite a significant turning point right there, and it rallied. Bitcoin rallied from this low to the top here about 26%. So they're dumping. Highest outflows for a vast period of time until you go all the way back to the August low, which was the significant low that we've seen, the major low for this move down. And from those 2 points, the market rallied. So basically do the opposite of what the masses are doing at those turning points, at or around the turning points. I say around because, well, this wasn't the exact low, but it's a pretty good area. If you're buying at 56K, okay, it goes to 52, you feel like absolute dog shit. You think the world's caving in, and maybe you even don't believe your own analysis. You just have to wait a few days in this case, and it's back to your entry price, and then it basically takes off from that point. So you don't have to feel the fear, the FOMO, fear of missing out on the way up. You definitely feel the FUD for 1, 2, 3, 4 days, and then it comes back. So that's the stuff that if you can get over it, you're going to be okay. For the majority, they feel shit day to day. They feel it hour to hour, and that's why they can't survive in this game. So the other recent one here is the high inflows, 27th of September. Here it is there. Basically, that was the highest inflows that we had seen since July 22nd. And guess what? It called the highest price for Bitcoin going all the way back to July. And if I just get that exact date again from the previous top, 22nd of July, where's 22nd? Right here. So there it is. There's the other top. The price went slightly higher, but it didn't close higher, which is a very, very interesting signal in itself. It wasn't able to follow through. The momentum didn't follow through. Major crash into August. So again, you had highest inflows at that peak, highest closing days that you'd seen, then a major, major crash after that point. Doesn't always have to be such a major crash, but again, just explaining that following on-chain analysis will get you wrecked. So I'm going to post about this on X as a reminder. Maybe it'll be the tweet for this particular video. Okay, so that's lesson number 1. On-chain analysis will get you wrecked. That's BTC for now. Short term, anyone's guess. You got lower highs now, lower lows, but higher lows on a longer term basis here. I say lower lows because you got this low here, then this low. Maybe if this ends up being the higher low over the next couple of days or so, then you start to see prices rise. But again, I can't call it from here because the prices are getting way too close. Where I look is a breakout of 65K and then this top here at 66.5, or the breakdowns from roughly 59.5, which is where this low sits. That could then trigger further downside testing of 56 to 57.5. Yesterday, I looked at the possibility of Bitcoin not going under 56K or closing under that price. I'll make it very clear that I don't know for sure. Obviously, I have no guarantees, but unless it breaks these couple of lows here, this one here, and this one here, it's probably very unlikely that we're going to retest the low, which is obvious sense, right? If it doesn't break this, it's not going to come back here, but that's just looking at the strength and weakness of this particular move. More on that in future videos as we get more data come through in the coming days. So let's have a look at a longer term basis here for the total cryptocurrency market cap. I said I was going to cover this yesterday, but I ran out of time. Essentially, we've got higher highs and higher lows on the weekly chart, still in a choppy range underneath the 50% of the downtrend here from March to August, but above the bull market support. This is our bull market support level, 1.7 trillion. That's your 50% of the entire bull market range. That's why it's a bull market support level. Super, super simple. Closes above 2.2 trillion are going to be the short-term signs of strength, and it may be relatively quiet out there in the space as it slowly grinds higher, consolidates, and then it all starts to rush all at once. You know, you'll start to see more and more posts of things popping off. You'll see the FOMO creep into the market. You'll hear of altcoins and 10x's and 50x's. All that shit starts to become far more dominant once we first break 2.2 and then each of these significant tops here, more importantly around that 2.6 to 2.7, as that's when we start to run away to the peak. Now, the other interesting part here about the analysis is how close we are to the previous old cycle top, so the previous old all-time high. The current drawdown is about 30%. Last cycle, it was at this particular time, so somewhere around that October-November period, about 100 weeks from the low. So let's move this to the cycle low there. It's about 23 months from the cycle low. Bitcoin's price was about 38%, 40-ish% from the old all-time high. So we are closer to the previous top in this cycle than we were in the previous cycle. That just means there's more money in the system now, because I'm looking at the total cryptocurrency market cap. This one includes Bitcoin, ETH, and stable coins. So it encapsulates absolutely everything in the crypto market, much closer to that top. Nice looking consolidation here. And ideally from this point, we start to break higher and then we get that nice big move to the upside that we're all hoping for. So on to point number 2, but just before I do, obviously like and subscribe if you haven't already. Now, if you're not ready to commit to TIA Premium, you can also check out the free Discord with reports and results from our members and reviews as well. Just subscribe to the free report. You'll see the email to get access to the free Discord. There you can check out the trading results from our traders here doing very, very well with all of their trades using trading plans that they have learnt from TIA Premium. So congrats to you guys. Really, really killing the game here. Very, very well done. And it's good to see other people doing so well with their trades. You can also check out TIA reviews, lots of these coming through as well. Just click on that, absolutely free. Go back and scroll years and years worth of reviews here if you so wish. So that leads us over to the second thing. The second thing is around this date. We talked about elections, what happens moving forward. There are no guarantees in the market. I just like to look at the probabilities and share those probabilities with you. In this case, this bull market might be too, but it is still young. The point here is the bull market is young and there could be many more gains. Now I'm going to look at it after from the election dates or around these election dates moving forward. But just to recap this particular data here, going back to 1949, call around 1950, so over 70 years now of data here. The years, and then you've got did the bull market start in October? Because we've done a fair bit of analysis on the channel showing how many of the lows in the market come around that October period. There are several other months which do relatively well for lows, October being one of those in particular. Looking at the bear market bottom to bull market peak, there are the dates. Here is the percentage gain. That is the amount of time with how long those bull markets ran for and whether they started in October. Looking at the percentage gains, the average is 180%, the median 108%. In terms of years, 5 to 5.5 years. So as just as a bit of an example here, something to get a bit of hopium for, the start of the bull market, October 22, this was the time when there was recession, inflation, interest rates, economic collapse. It was all over. October 2022 was death's door. 2 years ago, death's door. Now we're up 60%. What does it look like going forward 5 years, which is about 60 months? 60 months, this is just averages, takes us out to October 2027. Let me get that date right. There it is. Now, 5.5 years would be 66 months. That takes you to April 2028. I've talked many times where I think the real estate and economic cycle, according to the 18-year cycle, it's going to peak around 2026. It doesn't mean it goes straight up, comes straight down. Bell rings, everyone gets out. It doesn't look anything like that in practice. It's just a roadmap for trying to reduce your risk. I'm not going to go ballistic at those times when it seems like things might be getting a bit too hot. Having said that, the stock market, remember two different things, that could keep going. This thing might keep going into late 2026, maybe 2027. The point here is that it basically can keep going longer than we expect, just like the bear markets might go on longer than we expect as well. What we'll do is follow the charts, follow the swing indicator. Like you can see on this yellow line here, I'll just leave this over here for us at 180%. Let's do that first. So about 9,800 points. Sounds crazy. Let's just do the median at 108%. That seems a bit more reasonable, around 7,300 points. I've already got quite a few targets here at 61 up to 7,000 points as well, where I think the S&P 500 is going to go. The point to follow is the Gann swing indicator, watching the monthly swings and how it remains intact. So if you keep following and you see monthly swings remain intact, or if they break down and then reverse to go back with the trend, as I'll show you in a couple of examples, then that's another signal to keep going with the trend until the trend ends. Check out 2021 into 2022. After COVID, higher low, higher low, higher low, higher low, and then the breakdown begins. Now, it doesn't mean that it's going to be the absolute end until you get the trend continue, lower highs, lower lows, that's it. It's time to take a step back, or if your plan says short, you do what you need to do. But essentially the trend is down from that point, lower highs, lower lows, according to the swing indicator. So that leads me to the elections now and what happens from this point forward, how much gain, and then basically the time frames. And so what I'm looking at here are a measure of basically the month before the election and then all the way up to the peak before the swing indicator breaks the monthly low. Some of them are going to be a little bit up to your discretion, but I'm going to make it as mechanical as possible just to review the percentage gains and the time frames so that we can have another bit of a projection forward. The last election, 2020, ran all the way up 49% from October 2020 to the peak, 15 months, 49%, all the way to that peak there, and then you had a breakdown of the monthly swing low. So that's where I'm stopping the reading. The next one back, we had 39% from October 2016. September 2018 was the top, 23 months. And remember, this doesn't always work out, but over the last 20 odd years, it has been relatively good. The 2012 move here, there's October, 1 month down, but then the swing in the yellow line that you can see in the background here didn't break down until October 2014 and then kept going, and then it finally broke down in 2015 as well. So I'm just taking to that first peak, 44%, 23 months. So we've seen a roughly 40%, another 23 months, and we've also seen about, not half that time, but less, 15% and 49. Sorry, 15 months and 49%. So it's been pretty regular this entire cycle so far. Now, the 2008 one essentially failed. You can see the breakdown of the monthly swing bottom. You had a lower one here, but you're already in a downtrend. So if you were just to buy in this October period around this, within this October here, or if you bought at the very beginning of October, well, you'd basically be at break even by the time it got to that next peak, which for a bear market after that low when everyone thought the world was over isn't the worst thing in the world. I'd still call it failed. I know I'm not going to try and sit here and claim it being 100% accurate. It's definitely not that. But nonetheless, just looking at it in terms of a data point, it's a failed one. If we want to have a look at it from the low of October to that peak, about 45% in 18 months. I just want to get a bit of a measure in terms of time until the monthly swing chart breaks down after the election, right? So it's already in a downtrend, it turns into an uptrend, and then it breaks down again, about 18 months from that point. Again, 45-ish%. Here in 2004, so going back 20 years, that's October, and then the monthly broke, but then you could get back in with the trend and follow it. It broke again, you get back in, it broke again, you get back in until the peak, and then it breaks down. Again, 44%, so around the same sort of percent. The thing I find very interesting here is that the percentages have been roughly the same throughout the last 20 years. The timeframes, however, median around that 2-year mark, 23 months. We've also seen 15 and 18 months, and then this one here is one of the longest ones at 36 months, and this is the stage of the cycle that we are in. We're in the winner's curse phase in the second half of the real estate cycle, and this is the only time so far in the last 20 years that was in the second half of the real estate cycle in the winner's curse phase, and it went for the longest period. Albeit it did break down a couple of times, but you could get back in with the trend as we talk about with the swing indicator. Anyway, 44%, 36 months, and if you want to do it strictly using the mechanical plan here, 5 months with a 12% gain. So there have been a few failed attempts when we start to go back. 2000 into 2001, definitely a failed attempt here, but that was after an absolute skyrocketing bull market. And from 96, you had a 21-month move with a 74% gain before it broke down. And if you really wanted to go absolutely nuts, take October to that final peak. There's 127%, 41 months. But nonetheless, I'm using the strict mechanical plan. If you just got in and then sold, at that breakdown, you wouldn't be getting the 74%. I'm just looking at this in terms of time frames itself. You'd be getting a little less, so somewhere around the low to the breakdown, about 56% there. Anyway, the point that I want to look at is the time frames here, about 21 months. Now, I could keep going and doing this, but of course the video is going to go on forever if I do the back testing throughout the entire history. There was another fantastic one here, 16 months, 15 months, 34 months. So we've seen that a couple of times now, 36 and 34. Then in the 60s and 70s, it failed. And then you started to have a couple more here. 7 months, 14 months, failed. Then in the end of the World War II, you had another positive result. You had a failed result at the beginning of World War II. You had one winner here in 1936, and then you had a loser in 1932 into 33. The reason why I've got a percentage here is because you've come off the back of the Great Depression and you're bouncing out of this low, which you could get back on board with. That one there was about 9 months, 90% to the top until it took 2 years to drop to the downside. As I said in the intro, it was about 100 years of data that I went through here back to 1920. The data gets very sketchy for the S&P 500 when you get into the 1920s here. As you can see, there's really no highs or lows. It's just basically an open and close price. Failed in 1920 here, but in 1924, which is why I went back this far, it's a 100-year repeat or 100-year cycle. Maybe we repeat something like this. It's about a 5-year move to the upside, 250%, and it encapsulates another election from 1928. So you got the 1924 election, 1928 election, 11 months into that peak, another 51%. And if we want a clearer look here, I went to the Dow Jones, which has much better history. And you can look back all the way into the 1920s and you can see the actual swings themselves in the market. And that's basically just an absolute skyrocketing stock market. But do note that the real estate and economic cycle, this one here that I look at, peaked around, if I'm not mistaken, 1925-ish, which I'll have to go back and research, but I'm trying to remember all of the data points in my head. I believe it was around 1925-26, but the stock market kept going. That could be a real possibility for 2024 into the end of this cycle in, who knows, 2027, 2028, I don't know. I want to just keep following the chart, and if it gets stronger and stronger and the moves get more and more vertical, then you just have to keep respecting it, that markets can remain irrational longer than you can remain solvent. You and I can remain solvent, right? So if we keep trying to short markets or expect a top and say that it's gone on too long, that's usually the case where it just keeps going. And if that is the case, you can see basically how vertical this market continues up. So that is my second point for the video. What happens from now, around this month before, 4 weeks before the election, until any sort of monthly breakdown on the swing chart after the election. In several cases, at least in most recent history, around 20 years, we've had one failed attempt, which is the GFC. I don't think we're at that time now. That might be the 2028 election, where we get something similar to 2008, 20-year-ish repeat there. Nonetheless, you've had 15, 23, 23, roughly 18, 36 here. And then in terms of percentages, all roughly about 40 to 45%. So what does that look like on the S&P 500? Well, let's take it from now, October. This is the current low. It's all the data that we have. If I go up for 15 months, that takes us out to January 2026. We've seen 23 months as well. So that takes us to about September 2026. And if we go up by 45%, there's 8,000 points. One of the lowest readings there was about 39%, I believe. So about 7,900. So relatively high. I don't know if it's going to get there. I'm just looking at averages here. The main thing that keeps coming up is that after this election, considering all of the narratives that continue to build around money printing, credit being created for purposes of speculating in the markets, for purposes of buying real estate, those sort of things that we've talked about many, many times before, it seems plausible that we could see a similar repeat to some of these occasions when the stock market goes absolutely crazy after the election, which then could last anywhere between 15 and call it about 24 months. So basically 1 to 2 years after that point. It could go on longer. We'll continue to follow the chart at that time. Make sure you are subscribed to the channel and like the content or like the video if you find value from the content. Don't forget, link in the top of the video description. You can check out the reviews, the results, reports, tweets, all this sort of stuff, and updates as well in our free Discord. So what that data is saying to me, that it's basically too late if you wait until after the election, if you wait until the end of the year to decide whether the market is safe enough to enter. Now, I think, is a fantastic time. If you find entry opportunities that meet your plan, that's the time you should be actioning your plans, whether that's in Bitcoin, cryptos, stock markets, whatever it might be. But essentially, the data is suggesting that if we are waiting, then it becomes basically a FOMO game to get in. There's probably still going to be more gains as I looked at with that 15, maybe 20 months to go in the bull market. But it just becomes more risky because the FOMO begins to kick in the higher the prices go, which attracts more people. And basically, it just makes entering the market a lot more difficult because you end up waiting for pullbacks, which might not come to the degree that you're hoping for, or maybe that next analyst is telling you that pullback should come, which then keeps you out of the market, and the whole cycle rinses and repeats. You're waiting, it goes up. You're waiting, and it goes up. Why not action your plans now? If that's the case, I'd love to hear about it in the comment section down below. Now, we still have Ethereum BTC, altcoins like Sui, and another great piece of Bitcoin data, one that might suggest a turning point is on its way, but I'll leave that for a future video as we're out of time in today's video. Thanks for joining me again. Until the next one, take care and peace out.